Welcome to the ETF Show, taped here from Asset TV studios in New York. I'm your host, Kristen Myers, ETF Editor-in-Chief for Asset TV. Now, 2026 might be the year of international, though international funds are only about 15% of all ETFs. In January, international ETFs raked in $51 billion. That's about a third of all net inflows for the month, and the highest monthly flows for international ETFs on record. Now, the strong start to the year comes after international equity ETFs set a record in 2025 for inflows, doubling their 2024 returns as a weaker U.S. dollar helped boost demand. To discuss, we're joined now by Nick Kalivas, Head of Factor and Core Equity Product Strategy at Invesco. Nick, thank you so much for joining us.
Oh, it's a pleasure to be here.
So as I just mentioned, that stat, international equity ETFs pulling in $50 billion in January, actually over $50 billion. And that, again, was their largest monthly inflow on record. I'm curious to know what really changed to fuel this kind of demand.
Well, there's really a number of dynamics that are taking place. I think, first of all, investors still are a bit underweight to international. So that started last year where they were gaining kind of traction with their overseas investments. And I think that flowed into early this year. The other dynamic, which I think is important, is that when we start to look at the earnings picture has really improved, especially for emerging markets. I mean, in some cases, depending on which index you look at, it could be developed. But the key there is the AI trade has kind of rotated from the hyperscalers and the big US names to what I would say is the memory makers and kind of the nuts and bolts makers, which are heavily in Taiwan, they're heavily in South Korea. And so that has really helped interest there and has been a big driver of return. I think the other dynamic is you've seen more friendly policy, especially if you look at it, Japan, there's a lot of optimism that the new prime minister will create stimulus. Last year, we saw the Europeans do some stimulus in terms of defense. And, these things are kind of working into the profit outlook. And that has kind of raised the reasons for investors to look overseas, along with what has been a pretty weak dollar.
I want to talk about that allocation that you just mentioned, sort of at the beginning of your answer. As you were mentioning, a lot of investors have repeatedly been under allocated to international and for quite some time. But as I was mentioning, essentially international funds pulled in about a third of all inflows in just January. So as you're looking at some of the numbers right now, do you think that allocation problem has been corrected, or do you think there's still more room to go in investor portfolios?
Well, I mean, when you compare it to some of the flows that we've seen, just like, let's say, U.S. large cap, there's still, I would say, kind of an underweight there. The one caveat has been all these flows and some of the sentiment indicators do suggest that you might be at kind of a near-term overweight. But I think there's still a pretty long runway as long as kind of the dollar stays somewhat weak. And the reason why I say the runway could be longer is the fact that some of the stimulus dynamics that are present, they're going to be working through the international markets. And there's really no sign that kind of that secondary AI trade, like the memory makers and kind of the equipment makers that are sitting there in Egypt, like that's run its course yet. So those are a couple of dynamics that could keep people interested in international investing.
So it sounds like you don't necessarily think that this is a temporary rotation out of U.S. equities, because I'm curious if you're thinking that what we're really seeing here is really the middle of a trend of a longer term sort of leadership shift.
Yeah, I would say the idea of a middle of the trend seems to make sense to me. I think the kind of the initial phase and kind of the identification of some of these drivers, that's what some of last year was about. That's kind of what we see early this year. And I think you still have this kind of the story is going to be playing out, let's say, in the next couple of months. The dollar weakness that has been a driver, that should still continue to be present here I would say for the next 6 months. Then the comparisons are going to get a little bit tougher, and the dollar might have to go a little bit lower to get people interested. But in the next few months, it seems like the fundamental backdrop is still constructive.
I'm curious because you mentioned valuations, right? I mean, US equities are pretty expensive, especially when you compare them to their international counterparts. Something else that we've heard a lot of investors talk about this year has also been concentration risk. And I'm curious to know how much of this shift that you're seeing towards international to be partially to address that concentration risk that a lot of investors have in their portfolios right now, particularly to some of those, mega cap, big tech, high growth names that, again, are so incredibly expensive right now.
I do think it's part of concentration, although some, depending on your EM, or depending on your index, you might actually have some concentration there given the size of some of the chip makers overseas. But I definitely think it's this idea of diversifying away from the Mag 7. And I think it's also with that, this idea that the profit picture for the hyperscalers in the US, because of their big capital spending, is kind of come into question and it's being more debated. And so people, I think, or investors are looking for a kind of a secondary way to play AI. They're looking for other AI players, and some of those are present emerging markets. I think along with that, we saw this last year that investors started to look a little bit to China because they realized the U.S. is going to be a big player in AI. They realize China is probably going to be a big player in AI. And the question around Europe is, are they going to be there? So some of the flows that we've seen reflect that also.
So let's talk a little bit more about EM, emerging markets. They pulled in 19 billion in January. Curious to know what's fueling the demand specifically for emerging markets. Are they just benefiting from the broader sort of rotation towards international, or is there something specific there about EM that is really fueling a lot of this investor demand?
Yeah, so it looks to me when I look at the data, a lot of it has been to the EM exposure, where you have kind of South Korea in there, and you have some of this the tight supply and demand that's present in chips, and so I think that's part of it. I think the other part of it is when you look just blindly at the earnings changes, relative to the S&P 500, and even to the the mid sector in the US, EM is expected to see a really big increase. EPS growth is expected to go, from about 9% last year up to, it's supposed to increase by almost 34%. So the delta in earnings really favors EM, and that has, I think, caused money to go there, looking for that growth to play out in terms of price.
How much do you think the currency dynamics also at play here? I mentioned, at the beginning, we do have the weaker dollar really fueling a lot of this demand.
It's really a big factor. I mean, we've done some research here. We have a momentum, International Development Momentum Fund, IDMO, and if you look at its returns, the correlation between the dollar's change and IDMO NAV return is minus 0.75. So very, very strong relationship that we're seeing in our product line. So it is a driver, and it's probably going to be somewhat of a tailwind, even if the dollar sits here for a while for the next quarter. But I would say a new leg lower, it would certainly be helpful to the story. So the dollar is definitely part of the story, along with the earnings picture.
Now, something you mentioned a little bit earlier, Nick, you kind of touched on a little bit about there's geopolitics, but also global financial policy, right? That is also acting as some tailwinds, especially in certain regions. How do you think about those geopolitical headwinds and also tailwinds? Because instability and risk has been one of the reasons that a lot of investors have actually shied away from international in the past. So how are you thinking about that as a part of the equation in 2026 and even beyond?
Well, I think when we look at it in the emerging markets for sure, but even somewhat in Europe, given what's gone on between the UK and Russia, it is a dynamic that's present. I think investors have to kind of manage that risk in terms of their allocation, meaning they might want to have maybe a little bit less than what they normally do because of it. But I think it is really part of the reward or the wall of worry that is present. I mean, there's really no overcoming it, especially I think when you think about Latin America and the political dynamics that are there. Certainly, policy out of China can change rapidly, and you have kind of the instability in Europe and the Middle East. It's just part of the game, and I think investors have to be comfortable with their allocation and realize that's a bit of the nature of the beast, and hope that essentially they will be rewarded for taking that risk.
So to that point, are you seeing really more investors leaning towards, broader international exposure? Are they being a little bit more targeted in terms of either single country or regional or region specific funds as a part of the total international allocation?
It's varied a little bit. I mean, I think at the EM level, the broad index type of ETFs have taken in flow, but we've seen very strong interest in South Korea and Japan specifically. There's been much less interest, let's say, in single country European ETFs. So I think that investors at some level are really tuned into the different policies, and that's where we see, I would say, the bigger country-specific events. But generally, in my discussions with clients, it feels a lot of time when they allocate outside of large cap US, they are more data centric. I just want to get the exposure. We're trying to change that, and we have seen that a little bit recently. When we look at our firm, we're seeing more interest in momentum, which is a great international strategy because of the dispersion and the opportunity, that kind of price decide where you're going to be. We've seen it play out a little bit in our IPKW, our buyback. Why is that? Because investors, when they look overseas, they see a lot of cyclicals, they see a lot of materials, a lot of financials. And so a lot of times international stocks always look cheap relative to the US. It's just a more growthy market. And doing something like a buyback is a way to maybe get access to the value factor and really get a better value signal from the management action, as opposed to just looking at a price to earnings ratio.
Do you think then that this sounds like active strategies might be the best way to go when approaching international? We've seen active strategies really raking in billions in flows and a lot of investor demand for actives because of complexities and some of the nuances of dispersion that you're talking about. So do you think that when looking at international, active strategies perhaps are a better strategy than some of the passive ones that we see out there?
Well, I would say a couple of things to that. I mean, first of all, S&P puts out kind of an index versus active report where they look at how does active, perform relative to the index. And a lot of that performance kind of varies by region, but globally, you don't see kind of a huge advantage there. Where I think investors, and this might be a way to think about it, using a factor-based strategy, something like momentum, something like buyback, something like quality. Clearly I'm talking my book a little bit, but I think when you look at like an IDMO or an IPKW, you're going to see very good performance across the history, where you have kind of an index, but an index that's kind of harnessed a factor, and one that is actually, turning over, doing stock selection, is just doing it in an unemotional, systematic way. So I do think that there's a potential to generate alpha in terms of trying to use factor-based strategy. Active managers do that too, but I would point out to the fact that the results there in terms of international equities aren't like a whole lot different than what we see in the US.
For any investors that are watching this and they're thinking, yeah, I really need to start allocating more towards international and perhaps moving a little bit away from these US equities, how should they really be thinking? And you've touched on this a little bit, but how should they really be thinking about that allocation to international, especially if they realize they're very underweight in their own portfolios?
Yeah, so I think one, it's being comfortable. I think two, it's how much tracking error or how much different from the broad index do you want to look? And then, from my seat in my chair, it's trying to implement strategies where I might be able to generate some excess return. The cost of that may be tracking error or difference from the benchmark index. But I would argue that the combination of certain factors like value and momentum together, or maybe value and quality, can help provide some of that short-term diversification, but kind of harvest that factor premia kind of across the market cycle and provide something that is unique, and something that makes an advisor look or a portfolio allocator look like they are actually adding value. It's kind of using the building blocks of factors to optimize your portfolio internationally.
As you're looking out at, the remainder of the year, I'm asking you to grab a little bit of a crystal ball, so to speak. But if we do continue to see international outperform U.S. equities in 2026, what do you think is really going to be sustaining that outperformance this year?
It's really going to boil down to earnings. Like as we march through the year, are those earnings meeting the high expectations, the expectations? Like, are they actually moving faster than what we see in the U.S.? So earnings, 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 and then I think the other dynamic would be what is the picture for the U.S. dollar? That will also be very influential. I would say that question will become more important in the second half of the year when the comparison to the dollar weakness get much tougher. Like last year at this time, that's when the dollar was kind of at a peak, and then it started to decline when we had the tariff tantrum. And so that's something to look back in your head in terms of that rate of change, which is so important to performance.
All right, Nick Kalivas, Head of Factor and Core Equity Product Strategy at Invesco. Thank you so much for joining us today. And thank you for tuning in to the ETF Show.